morning. My name is Miguel Gonzalez and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about ways to minimize taxes on your investment portfolio. Improving return by minimizing taxes is very important. Although we are all obligated to pay our fair share of taxes, few of us would be pleased to pay taxes unnecessarily. Because taxes lower the actual return on your investments, you should be interested in legitimate ways to minimize taxes on your investment portfolio. Several approaches and strategies exist, including the following: year-end tax planning. The basic strategy for year-end tax planning is to time your income so that it will be taxed at a lower rate, and to time your deductible expenses so that they can be claimed in tax years when you're in a higher tax bracket. Year-end tax planning involves not only a review of your income and deduction situation, but also the use of checklists and marginal tax rate analysis to help you minimize taxes. Generally speaking, taxes should be postponed whenever possible. However, there can be circumstances that warrant paying your taxes sooner rather than later. For instance, if you anticipate being in a higher tax bracket in the future, or if you know that new or higher taxes are to take effect in the near term. The retirement years are also important to consider. It is important to manage income taxes on your investment in retirement. In addition to considering the capital gains consequences of investment decisions, you should also manage and control your investment income so that your Social Security benefits either will be not taxed at all or will be taxed only minimally. In addition, you must ensure that required minimum distributions from pension plans do not push you into a higher tax bracket. What about estate taxes in your portfolio? If assets are such that you're concerned about minimizing estate taxes on your portfolio, you should pursue strategies today to minimize taxation. Review your investment portfolio for estate freeze possibility, which remove future appreciation of your assets from your estate, and consider gifting to loved ones. Also, lowering your tax bite with mutual funds? Well, you can also minimize taxes by investing in tax-efficient mutual funds that never pay dividends, that purchase securities immediately after they have made large dividend interest payments, or that try to limit capital gain exposure. You should also try to delay purchase of mutual funds or stocks until after it distributes income, dividends, or capital gains. But I caution you, investing in mutual funds involves risk, including possible loss of principal. But there are advantages to capital losses. Understanding how to use capital losses effectively can make a difference in your portfolio's after-tax return. If you expect to recognize a capital gain this year, you should review your investment portfolio for possible capital losses to offset the gains. Likewise, if you have any capital loss carry forwards, you should review your portfolio for capital gain opportunities to make use of the capital losses. And taking advantage of tax credit investment opportunities. Understanding how to use tax credit programs as part of your investment portfolio can provide significant advantages. The low income housing credit and the qualified rehabilitation expenditures credit may provide you with income, tax credits, and tax deductions. So what to do with highly appreciated assets and unneeded income producing assets? I get this question all the time. If the value of your investments have increased substantially and you're concerned about capital gains, there are several strategies you may consider to minimize taxation of highly appreciated assets. If you have more income than you need and are searching for ways to minimize your taxes, you might consider gifting unneeded income producing assets to relatives who are in lower tax brackets. What about buying on margin to provide a tax deduction? Well, if you borrow money from a broker to finance your purchase of stock, you may be able to deduct margin interest on your tax return. Caution here is where a margin account holds dividend-paying stocks, certain considerations apply. Qualifying dividends paid to individual shareholders from domestic corporations and qualified corporations are taxed at long-term capital gains tax rates rather than ordinary income. However, for purposes of the deduction for investment interest, which is limited to the net investment income is not considered to include qualifying dividends subject to tax at capital gains tax rates. Individuals may elect to treat such dividends as investment income for purposes of deducting investment interest, but doing so makes the dividends ineligible for taxation at capital gains tax rate. Another caution here, similarly with long-term capital gains, are generally not included in net investment income for purposes of determining deductible investment interest, unless an election is made to pay the tax on the capital gains at ordinary income tax rates. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to subscribe to my YouTube channel to receive a weekly video podcast every Monday morning. Thank you for watching, and I look forward to seeing you all next week.